Hey everybody, Smart Silver Stacker here. China is making some huge moves against the US dollar right now, and this has massive implications for anyone watching the gold and the silver markets. We're talking about state-run Chinese banks placing multi-billion-dollar short bets against the US dollar, all while stacking up gold reserves like there's no tomorrow. Today, we'll break down what China's $100 billion short bet means for the future of the USD. And we'll explore how China's US debt dump, secret gold buying, and moves to de-dollarize the global financial system could send shockwaves through the markets. So, let's get to it. I do want to say a big thank you for tuning into today's video. If you enjoy it and you get some value from it, please do give it a big thumbs up down below. And if you like videos like this one about gold, silver, and the global economy, why not subscribe to the channel? Did you know SD Bullion is giving away a monster box of 2024 Tree of Life silver coins? Sign up today at sdbullion.com/sweepstakes. Okay, so let's start with this headline here. China's state banks have built up over $100 billion in short positions against the US dollar. That's right, China is literally betting on the dollar's decline, using financial instruments known as foreign exchange swaps to profit from any devaluation. In practice, Chinese banks are swapping yuan for dollars at predetermined rates. If the dollar weakens by the time the contracts end, they profit. And this isn't just some small side project. These swaps are part of a broader currency management strategy designed to prop up the Chinese currency, the yuan, which has been hit hard by Federal Reserve rate hikes and China's own slowing economy. But here's the thing. These swaps have brought in nearly risk-free profits of up to 6% for traders taking the opposite side of the bet, and Chinese banks are walking a financial tightrope. The $100 billion could actually grow to as much as $300 billion in exposure, making this a massive gamble. If the dollar strengthens instead of weakening, the losses could be staggering. Already, estimates of losses range from $5 billion to $16 billion. So why would China's banks take on this level of risk? Well, for Beijing, supporting the yuan is crucial to maintaining economic stability. China's central bank, the PBOC, is trying to prevent a rapid decline in the yuan without burning through its foreign exchange reserves. By allowing state banks to absorb the pressure via these swap deals, China avoids having to intervene directly in the currency markets, which could lead to further speculation against the yuan. Essentially, it's a calculated risk, accepting potential losses now to avoid an even larger crisis down the road. And there is one other reason that China might be willing to take on these risks. Sure, a weaker yuan makes Chinese exports cheaper on the global market, which is critical for a country that relies heavily on exports for its economic growth. But while a weaker yuan might give China a leg up when it comes to exports, it's not all sunshine and rainbows. A cheap yuan makes energy imports pricier, which is bad news for a country that relies heavily on foreign oil. And then there's the risk of capital flight, investors pulling their money out of China. Not exactly what you want when you're trying to grow. President Xi Jinping also has bigger ambitions here. He wants China to be a global financial powerhouse. To get there, he needs a strong and stable yuan, something that could even make it a contender as a reserve currency. Xi himself has made it clear he wants a, quote, powerful currency as a key pillar of China's rise. At the same time, these actions create ripple effects throughout the global economy. Investors in other countries are watching closely, because if China's strategy works and the dollar weakens, it could signal a shift in global economic power. But if it backfires, the consequences could lead to more volatility. But it isn't just currency swaps that are on the table here. China has been dumping US debt at record levels. In the first quarter of 2024 alone, China sold off more than $53 billion in US treasuries. That brings their total US debt sales to around $300 billion worth since 2021. This isn't just a reaction to domestic economic pressures either. It's part of a broader strategy to de-dollarize its reserves and reduce reliance on US assets. China isn't alone in this effort either. We've seen the BRICS bloc, Brazil, Russia, India, China, and South Africa, along with new members, Iran, Saudi Arabia, and the UAE, among others, making significant moves to weaken the dollar's grip on the global financial system. This effort is likely to escalate later this month when the BRICS countries meet in Kazan, Russia. The agenda? Reducing reliance on the Western-dominated financial system. We've already heard whispers about the possibility of a gold-backed BRICS currency, and if that happens, it could be a game changer for the global monetary system. A move like this would likely send gold prices soaring as countries around the world seek to diversify their reserves away from the US dollar and into tangible assets like gold. By the way, did you know that in the United States, we already actually have a gold-backed legal tender currency that circulates in 5 states? They're called goldbacks, and you can learn more at goldback.com. Now, speaking of de-dollarization, here's a stat that should be on your radar. The yuan has officially surpassed the dollar as China's preferred currency for cross-border transactions. As of March 2024, the yuan made up 52.9% of China's cross-border payments, compared to the dollar's 42.8%. That's a massive shift from just a few years ago, and it's a clear signal that China's efforts to reduce reliance on Western financial systems are working. We are seeing more and more countries turning to local currencies for trade, particularly in Asia, Africa, and Latin America. This trend is only set to accelerate, especially with BRICS pushing for more use of local currencies in international trade. Let's put this into perspective. In 2010, the yuan was barely used in global transactions. Fast forward 14 years, and it's now outpacing the US dollar for China's global trade. This is a major development, and it highlights the growing influence of China's currency on the world stage. But let's not forget about gold. For years, China has been quietly building a massive stockpile of gold. In 2023, China was the world's largest buyer, and while they officially paused their gold purchases in May after 18 straight months of official buying, there's strong evidence to suggest that they've been buying gold in secret. According to financial analyst Yuan, China may still be purchasing gold off the books. Back in 2022, the US froze $300 billion in Russian foreign reserves. Since that time, discrepancies have appeared between World Gold Council estimates of gold purchases and official IMF statistics, indicating that central banks, aka China, could be making covert purchases to avoid driving prices even higher. Why the secrecy? Well, China has good reason to keep these purchases under wraps. With gold prices at record all-time nominal highs, Beijing likely wants to avoid sparking a surge in the gold price. By quietly accumulating gold, China can steadily build its reserves without disrupting the market. Plus, as the world inches closer to a potential currency crisis, gold becomes an even more attractive safe haven. And if China is betting on gold as a hedge against dollar volatility, we should all be paying attention. Officially, gold now makes up 4.9% of China's total reserves, the highest level on record. But this level is still well below the global average of 16%. And some analysts believe the real number is much higher when you factor in covert purchases. China's gold buying spree is part of its broader strategy to reduce reliance on US assets and assert greater control over its own financial destiny. So what does all of this mean for gold and silver? Well, first off, we have to recognize that China's massive bet against the US dollar is part of a global trend towards de-dollarization. As China moves away from US assets and strengthens its own currency, we could see significant downward pressure on the US dollar. A weaker dollar typically means higher gold and silver prices as investors seek safe havens during times of volatility. And it's not just the dollar that is in trouble here. China's secretive gold purchases suggest that they are preparing for major economic shifts. As more countries diversify away from the dollar, gold and silver could see a huge surge in global demand. It's no coincidence that central banks are buying more gold now than they have at any other time period on record. So the big question now is, how long can the US maintain its dominance in global finance? With the BRICS nations pushing harder than ever for a new financial system, we are looking at a potential sea change in how global trade is conducted. And precious metals, well, they're going to be at the heart of that shift. So what do you think? Will China's short position on the US dollar pay off? And how do you see gold and silver reacting to these global shifts? Let me know your thoughts in the comments down below. And before you go today, don't forget to give this video a like down below, share the video with your friends, and hit that subscribe button to stay up to date with the latest on gold, silver, and the global economy. Thanks for watching, everybody. As always, stay safe and happy stacking. I will catch you next time. Smart Silver Stacker, out.